Okay, it's 10:13. Our next speaker is Dr. Bruce Sherrick. He's the Marjorie and Jerry Fruin Professor of Land Economics and Director of the TIA Center for Farmland Research here at the University of Illinois Department of Agriculture and Consumer Economics. He serves on the Federal Agricultural Mortgage Association board and also known as Farmer Mac, and teaches graduate and undergraduate courses in applied finance and financial modeling, and is involved with Farmdoc and Farmdoc Daily. So Dr. Sherrick is going to enlighten us on, wait, what just happened? And Dr. Sherrick, we'll let you get started.
Thanks, Dave. Just remembering and thinking back a couple of months ago when we talked by phone and we were trying to choose a topic, we kind of came up with this title, not knowing how accurate it would be. And we thought we would be talking about the incredibly strange year we had in 2019 and all the follow-ons, and try to figure out what that might have as implications for valuation in markets and ag in general. Little did we know what was about to happen. So what I want to do today, though, is talk about some of the major influences and try to kind of construct a narrative around what is really happening in farmland markets, so that when you go through the materials that are going to happen at the end of mine, hopefully we won't be quite so startled with some of the results, and it'll kind of begin to make sense, but we'll also plant some really important questions, I think, that we won't solve right away, but have to think about as we're looking at the market going forward. So to start, I will still go back through 2019 in a simple summary slide. As we all recall, we had this just absolutely strange spring. We hadn't really seen anything quite like this before in parts of the upper part of Illinois, upper Midwest, up into the Dakotas. And it was sort of the rain, go away song, come again. Well, July would have been nice. We kind of had a year where we were expecting yields to really be killed. Absolutely devastating summer, late planting, huge prevented plant. And yet the corn yields turned out to be a little bit of a surprise on the positive side. About 168 on corn, about 47 on soybeans, reasonable carryout in corn, and soybean carryout got cut in half effectively by the lower yields. So instead of having mountains of soybeans around, we just have foothills, I guess, of mountains laying around. The story, though, of the year was crop insurance. And crop insurance paid out almost $10 billion, much of that prevented plant. And as a program-wide, though, it's really important to recognize that the loss ratio was still less than 1. That's an amazing thing to say. Crop insurance did exactly what it was supposed to do. And I think folks really have understood, probably moved into kind of an understanding of the permanent nature of crop insurance in terms of managing a farm's risk. And I think we're in that for the long run. The map, we've shown this before in other presentations a couple weeks ago and so on, but just to kind of remind you, it really did pay where we had too much water last year. We also had a few, I'm not sure how to describe them. They weren't quite never waste to crisis moments, but they certainly were efforts to support the agricultural community through increased federal spending through the MFP programs, top-off programs. We opened up ARC and PLC again for reconsideration. And at the same time, we got to the end of the year and we still had questions about the rest of the world. Are we ever going to restore demand? Are we really going to get back to where we were with China after the trade disruptions? And 2 months ago, if you'd asked me, I would have said 2/3 of the slides would have been about trade, about prospects for restoring demand, for looking at some of the things Kevin talked about as well, the changing nature of demand, where attributes become increasingly large share of the value of the product. And how we were still a little bit unclear in terms of those deals and the US, Canada, Mexico bilateral and regional trade deals, how that was going to affect our long-term demand. And when we got all the way to the end of the year, thankfully, but perhaps surprisingly, the ag sector income was within range of normal, including all the government payments. And then we heard about this little virus from China. It's the turnover of the calendars when we started hearing things. And then we got our results back and not to take your punchline, Dave, but farmland values remain fairly stable, some strength even in particular pockets. Hang on to the end of the webinar today, folks, because one of the last slides in Dave's and Gary's set is really pretty fascinating to me in terms of what's really going on in 2020. And I want to lay out some reasons why I think that this actually makes a lot of sense. So when we get to what might look like perplexing responses, we're going to have to begin to say, gee, would you rather own commercial real estate now, or would you rather own farmland? We're increasingly hearing stories of commercial real estate management groups that are going on to rent moratoriums if a business can't collect or can't generate enough to pay the rent. Would you rather have a default and a swap over a business and then have nobody rent your place, or give them a 2-month hiatus on paying rent? Further, the sense that much of the shutdown has not been caused by individual actions, but in a sense mandated, changes the policy perspective substantially in terms of if you can't pay rent, but it really, in a sense, was something outside of the control of the business, and the government, in a sense, caused some particular inability to access your customers, what should be the fair split going forward. So that's 2019. 2020, if you notice, is meant to look like the same map. What do we look at, though? Well, nearly all of the news, all of the debate about policy, and virtually everything we do in our daily lives has been now driven to conversations or actions around COVID-19. This map was from yesterday. I assume that the numbers have changed. In fact, I checked late last night, and between my two sources, there was a 3-person increase in Illinois. 161 cases as of yesterday, 1 death, 2 recovered. So we're, by many people's estimations, kind of in the early stages of knowing what's going on. And at the end, like we do with all crises, we'll discover that we either overreacted, underreacted, or did it about right. And it's never quite apparent during the middle of the crisis, but we'll figure this out. One of the things we all look at our 401ks and say, oh my gosh, I have to work 3 years longer now because of the stock market volatility. And 3 months ago, we were saying, gosh, I get to retire early because of the stock market volatility. And what we want to do is compare to some degree what the returns would be to real assets and agricultural real assets in particular, and think about whether or not that might push some additional demand into real assets as opposed to financial assets and so on. We had, I think, one of the things that we do really well here at Farmdoc and at the University of Illinois is we stay really current, and we have commentary, I think, that is relevant in near real time. And increasingly, folks on the team have been identifying some of the linkages from COVID-19 to the agricultural markets, including the spillover from the lack of travel. So you use less gas, that's going to reduce the demand for ethanol, or changing demand for food that is in cans as opposed to fresh. And what do we do with the labor markets at meat slaughter plants, and how do we do processing and all of this? But the spillover from all this reduction in activity is clearly disrupting demand for commodities. And commodities, corn and soybeans up a little overnight, but generally down from even the end of February. So we'll think about that and whether it implies that ag in the new world is a relatively more desirable or less desirable asset. I've been fairly bullish over my career in general, with some muted periods of wait and see, but I think I have a similar conclusion at the end to provide on this as well. One of the other things that's really important, though, is the interest rate markets and how the government has combined, in a sense, the monetary and fiscal responses in a way that didn't even happen in 2008. Now, the magnitude was larger at the outset in 2008, and we had TARP and TALF and 4 waves of monetary easing. So the numbers were bigger. But the suddenness and the backstop messaging that seems to be coming out of Washington these days is a bit more direct, a bit more complete, targeted on disruptions that the government actually, to some degree, controls. And that's like the summary of the world is provided in the interest rate movements alone. So we'll look at that a little bit more. And yet, in the Midwest and in agriculture in general, we can't avoid the calendar from continuing to move forward. So we still have to do our planting. We still have to manage our inputs. We still have to move around. We still have things that have to happen. And it will. Spring is going to occur, whether we like it or not. We can't put a 2-week shutdown on that particular sector. So in all of this, we'll continue to look at what's it mean for farmland values, why, what can we think about learning, and how do we compare kind of recent histories to what we expect going forward. Very, very quickly, not to disrupt the flow, but one last picture from 2019. Whoops. How do I go back up, Jim? There we go. So we'll skip forward actually one, and we'll even skip the one that I thought was going to be coming next. Thinking about current hot topics for Illinois farmland, and thanks again for your patience online. We always do this in person, and we always have snafus in person. We'll have snafus not in person as well. You just won't get to see them as clearly. So probably should put a camera on us in here so you can see how ridiculous we look. So. But current hot topics for Illinois farmland, again, the COVID-19 is adding remarkable uncertainty, but directionally it remains unclear. We have people saying this is a once-in-a-lifetime buying opportunity in equities at some point in the future. We don't know when, maybe now, maybe in a month, maybe in 6 months, or do we have unprecedented chances to avoid market volatility by moving from financials to real assets? Those are decisions that folks in BlackRock and Apollo funds and others are making these days. The trade uncertainty and the commodity demand, though, I think the shrinking of that takes a long time to recover from. I hope I'm wrong. And as an economist, you can be wrong half the time and still claim yourself to be successful. But I'm worried that the commodity demand will take a little while to come back from and recover from on the trade disruptions as well. The comment I've been using for about a year now is that I think the half-life of recovery is about twice as long as the event. So if we ended up with, a year of direct impact from this, it may take 2 years to get halfway back. Point 3 on this slide is a very important one, and we'll spend quite a bit of time looking at some summary indicators around this issue. Interest rates, we hear, are declining. Treasuries, CMT 10 this morning was at about 1.1 or 1.13. By historic standards, a remarkably low rate. Got down to about 0.5%, 0.54. Dave's giving me details on this in real time here. And we were thinking for a long time that 2 to 2.5 was kind of the long-term normal under the new capitalization standards for banks, but we're in a brand new world again. But at the same time, credit spreads, or the amount you pay over what you would think of as the risk-free interest rate, have been widening. So farm interest rates and consumer mortgage rates have not fallen quite as much as what you might have historically thought of as your index for funding costs. So with credit spreads widening, but interest rates declining, we're generally seeing some tick down in interest rates, and we use that as a proxy for the cap rate required for agriculture and other investments. But it creates a brand new question. So for the last couple of years, we were saying ag was returning about a 3% cash return in rents, plus or minus, depending on where you were. And we would say things like, well, that feels really low compared to what you can get in equities or commercial real estate. But now I have to ask the question, is a 3% return to something with a very stable income pattern a high or low number? And I think that's one of the things that's going to actually influence how we view real asset markets, agriculture, farmland in particular, going forward. And then when we compare it to commercial REITs, or we compare it to commercial real estate, or we compare it to other things that have some real asset attachment, we'll have to make some judgments about whether or not 3%, but stable, with the possibility and strong possibility if inflation returns of asset appreciation as well, if that's a high or low number. Another really important thing is getting the responses to farm policy right. We have, of course, an election year. We have crisis mode. We have historic efforts to, in a sense, break from our untied farm policies to things that may have a little closer production tie. And I think in crisis mode, anything is on the table. I don't think we were going to ever threaten crop insurance, but that's become even more solid. I think the possibility of pushing out additional MFP, we hear, day to day, that's not likely, or it's likely, but in a different form, or we're going to support some other direct support programs. But that will be pretty critical to go forward through this year, because I think it begins to set up after the election year a more permanent approach to farm policy. I recognize that was a little bit of a nebulous presentation on that. That didn't say anything specifically, but I think there's a chance under any time when you have massive disruptions for people to change policy directions a little bit more dramatically than if it were, smooth sailing. The next item. It's really critical to recognize that the crop insurance numbers for corn and soybeans 388 and 917 are substantially above current market prices. That gives you additional coverage relative to yield times the price you get. You're more likely to trigger crop insurance, or crop insurance is providing a relatively higher floor than markets are saying are expected to be the revenue. That will affect, I think, as Gary indicated, some acreage decisions. We really have to worry about whether or not planting date shifts are going to create additional prevented plant questions again. But crop insurance is really there. Crop insurance is at a number higher than the current trade. And what that says about the likelihood of getting payments is you don't have to have as big of a disruption in yield as your deductible, if you will, or the difference between your coverage level and the 100% level to generate an expected payment. Kevin talked about the next item too, and I want to echo it, but echo it on a bit of a delay loop. Consumer-driven issues, or the attributes in production, are increasingly being paid for clear to the end consumer. And blockchain and other mechanisms for transmitting information accurately about the mechanism of production, which becomes an attribute, which becomes something the consumer pays for. We've heard about single cow burgers for a couple of years. I'm not sure how to get to that identification, or if we want it or not. But what started as a joke, I think, in the Portlandia episode about I want to make sure my chicken was happy, that with the turkey example, these things are starting to happen in the market in real ways. We care about what the production systems were. Organic becomes kind of a base attribute in certain products that didn't require a lot of inputs anyhow. Consumers are very worried about hormones in their meats. They're very worried about attributes. And this is very important because for the first time, and again, I've been somewhat bullish on its long-term impact on farmland, because to be able to associate and capture some of the value by changing a production system is becoming somewhat possible. Historically, I think it was really hard to say, gosh, I did this particular production practice, and so my conservation tilled corn should be worth more to the consumer than all the other number 2 yellow corn. But now it's getting to the point where we have information systems that are getting increasingly closer and closer to the farm gate. Again, historically, a lot of farmers, myself included, had concerns about what that meant when you had, Big Brother watching your production, but it seems to be tending toward what do you do to capture value out of production. But again, given while we're in this current mode, I think that's just kind of on a bit of a delay loop. We're not quite as worried about, whether Beyond Meat or Impossible is the better choice anymore. We're now worried about getting through this particular disruption. One of the places, though, that you've seen it this year that you hadn't seen it in the past included BlackRock and the statement made by CEO to say we're moving everything to include our understanding of the impact in sustainability and ESG issues, and kind of set the bar for the investing community to perhaps add value to agricultural production if it can demonstrate particular attributes. There are a lot of emerging, actually astounding numbers of emerging efforts to get credit for the marginal impact in ag for sequestering carbon. The counterfactual isn't if nobody ever eats again, how much carbon do we avoid? The counterfactual is, given that we're all going to eat food, are there changes that can be made that marginally reduce the amount of carbon emission or actually capture it? And the most amazing one, kind of that shouldn't startle anyone, is simply increasing the organic matter in your soil captures tons and tons and tons of carbon. So efforts to formalize those markets are beginning to appear serious to me. A couple of years ago, I kind of viewed it like, gosh, electric cars, they might eventually happen. and now I think we're kind of at the same stage with the efforts to tie sustainability and conservation efforts to something that can be monetized at the asset level. Looking into crop insurance prices and volatilities and some of the things that are just where we are today. This is a chart that won't surprise anyone, but I want to kind of remind everyone of the pattern that we've been in. This gives a 10-year history of projected prices, harvest prices, and volatilities. And of course, 388 for corn and 917 for soybeans for this year were pretty low projected prices. And that's kind of continuing a downward pattern. 2016 was the last time we had slightly lower. And if you notice, the volatility in corn was a bit higher then, but lower volatility factors result in lower cost of insurance, and lower projected prices result in lower cost of insurance and lower coverage. And those are important distinctions because the market was not saying there's a pending chance for a giant rally back when we were setting the projected prices. Depending on what we get from world demand and inability to ship in South America, we could get different things going through the summer. But if one of the things you should also notice is harvest price has not been above projected price very often in the last 10 years. Twice in corn, twice in soybeans. And both of those, what happened in 2012. We had a very well-timed drought for prices, not great for some of the farmers. And in 2016, we kind of had an event for soybeans that led us to marginally higher prices. So what's going to happen this year? I don't know. As of yesterday, corn was about 30 cents under, and soybeans were about 75 cents under. We've moved up a little this morning. But we're going to have to cope with that going through the season and as we get into the fall. The bottom pictures are just visual representations of the same thing to see. So one of the things that I like to do, and this is a little bit of a plug, we're not going to go real time to it. I thought maybe we'd switch back and forth between real time tools. Had we been all in Bloomington with good internet connection, we might have tried to do this, but we do have a really good way of saying, what do the markets say prices are likely to be going forward? We have a tool up, and the URL at the bottom will get you a connection to a place you can, with a couple more clicks, find this tool. But we have partnered up with National Center for Supercomputing Applications and built a fairly, I think, a really neat way of saying, what do the markets say? And just as of yesterday, I did this, I think, late in the afternoon or close to the close, but not quite at the close, and said, if I just looked at, as you can do, the drop down is by crop, by futures month, and by year. If we just did that, what the tool does is goes out and grabs the options data and the futures prices and figures out what the markets believe the likelihood of different price outcomes would be by expiration. And so one way to think about it is the markets as of yesterday thought there was a 74% chance of being below $4. Thought there was a 63% chance of ending below 375. And so one of the things I like to do is plug in the price of crop insurance projected price, 388, and say, as of yesterday, 70% chance that harvest price would not be above the projected price. Again, I know that's not positive news for folks, but it is part of the planning for risk management and the planning for what to do marketing wise and with summer activities. The next slide I'm going to is the one I'll probably spend soybeans as well. Wanted to put that one in real quickly too. About a 75% chance that we're not going to get back above projected price again as of yesterday. This slide is the one that I'm actually going to spend a little more time on than if this were in one of my classes, you'd say I'm spending a little bit more time than the students wanted, and this is a common slide that I've used for a couple of years now and just keep adding to the end. What this is a really, I'm going to use the mouse on the screen here. It shows the yield across time for investments of different maturity. So all on the Treasury curve. And what we see is September 2008, We had kind of a shutdown in the short-term interest rate markets, and then it took several years to get a recovery, but the long end of the yield curve still indicated that we were going to have positive activity. We were building up capital in the financial sector during that blue period, kind of in the middle. Each of the ripples is a government policy, primarily either accommodationist or credit easing policies. So we had TARP and TALF and 3 rounds of QE. And then starting in 2015, where you see the front end of that term structure ripple up. And again, each of those is 1 week at a time through last Friday. If you were to plot the yields of 1 month, 3 months, 6 month, all the way out to 30-year yields against the interest rate, you would get that pattern. And again, I'm not suggesting that the yield curve looks anything like it did in September of 2008. The front pictures look similar for different reasons. There's not a direct correlation, but in crisis mode, interest rates do tend to suggest what a large number of market participants are thinking about the prospect for recovery, the pace of recovery, investment, and they give us something really critical in terms of an expectation of earnings ability for real assets. That's the critical link here for agriculture. So we're currently in a very flat, low rate curve environment. At least we've somewhat gotten an upward sloping curve, which is critical. We get too many inversions and you end up with kind of shutdowns in middle market credit. There's just bad things that can happen if you get a downward sloping yield curve. We don't have that, but we have very low term premium. In other words, the difference between 10s and 1s or 20s and 10s is not very high. So we don't have long-term growth or long-term inflation built into the expectations here. Credit spreads, though, as indicated earlier, have actually increased in the kind of uncertain period that we started this crisis in, and I think those will normalize, frankly. Hope they do. But it means that your interest rate on borrowed money has not dropped as much as the index for the Treasury underneath it. For commercial markets or for what I would think of as the dealer debt market, we think of indexing to LIBOR or something other related to a stable funding rate. And those spreads have widened out for even high quality borrowers. So there's just the liquidity concern in the market right now, and that's made borrowing harder for the companies that are going to relend. The Fed, again, this is kind of what economists are starting to talk about, like accidental signaling of the wrong direction. The Fed has had emergency cut meetings twice now. These are quite rare, and the market views that as kind of panic by Fed as well. Rather than waiting 3 more days and doing the expected rate cut, the Fed thought that there would be some positive impact of saying we're out in front of this and we're going to go ahead and cut rates right away. The first cut was interpreted by the market as a different kind of panic, I think, and the second one likewise could have been done in lots of different ways. And in the end, we'll know whether they did it right or wrong after this is all settled. But to have 2 in a row is really rather unprecedented. So the last 2, both in the month of March, which resulted in a target rate of 0, really truly are unprecedented. What's more important, though, is the announcement of the repo market support, liquidity facilities that have been put in place to make sure that banks don't have overnight misbalances and short-term misbalances. It's been incredibly diversely described in the media. It's not a bailout. It's essentially a different way of making sure that lending facilities are in place. It's not a direct compensation for anything. It's just a way of saying we're going to add some grease to the short-term funding market, because we've learned that overnight what can get people, or short-term what can get people in the biggest problem is actually liquidity. At the same time, it actually results in the prospects for the first time ever of having negative real or nominal rates in the US. I don't think we'll ever get to nominal rates being negative in the US just because of kind of the pride of leadership in the world's interest rate markets. But real rates, if we have some deflation on a 0 base rate, could actually creep in. And that has really interesting implications for people who have long duration assets. It's generally very good. And in particular, if it's good for the assets that have inflation sensitivity like farmland. Again, I recognize this is becoming a little bit overly academic, perhaps, or a little too conceptual or theoretical, but it's kind of the way I'm setting up my thinking so that I know how to answer questions when people say, what could be the implications for farmland in the event of, and then fill in the blank. And instead of just saying, throwing your arms up in desperation and saying nobody knows, at least we have a kind of a conceptual approach to begin to look at this. I think what's also interesting about the kind of last couple years in this long-term picture, I always call it, brief summary of history. The Stephen Hawking book, Brief History of Time. I think this is a brief history of history as well, that it summarizes an awful lot of things about what were going on. You can just very quickly pick out when people were worried about .com, when the housing crisis happened. By looking at the long end of the yield curve, you can see when the government buyback programs were started and ended, and it does actually, I guess, manifest or result in this picture through time, what we do with large numbers of policies that impact the cost of money or the cost of capital. So taking that same picture though, and just doing the following thought exercise. So reading from the bottom up in the legend, if we take the first Friday with trade out of 2015, 16, 17, 18, 19, and 20, and look at the purple line, we had a very, very low short end, but increasing yield curve. 2015 and 16 were still recovery. 17, the first red line, starting to get into a period with positive short-term interest rates, long-term prospects increasing, moving up to 18. 17 and 18 are kind of the same color lines because they're kind of the same economic period. Moving up to 19, the green, we got into what, at least given my participation in the financial markets, I thought, hi, gosh, we're finally on our path back to something that's kind of normal. And then the dark green, 2020, okay, well, things are slipping down a little bit, we're still okay. And then the dotted lines, which are not on annual, the solid lines are on annual increments, the dotted lines are not. So what happened is, well, oh gosh, we're starting to panic, or shouldn't have used that word, but we're starting to become concerned and we're starting to move it down. And then as of last week, we have the dotted line that's lowest on the chart. And we all know that this is a somewhat temporary response while we're in kind of under all kinds of other kinds of uncertainty. But look at the vertical blue line, the thin line. If I just said I have a 10-year duration asset, what would be the appropriate cap rate for that if it were risk-free? And I could say, well, I can always go to treasuries and in fact implement that. I can go buy a treasury at that rate, at that term, and I could hold it till maturity and I could force an outcome. Well, we use that idea then to say, what would be the rational value of farmland as cap rates change? But farmland is not risk-free. So we also have to make a small adjustment for the difference between the interest rates that we're observing in the macro markets and what we would use to apply to a holding of something like farmland. And again, I with no cameras, I can still see a lot of the rolling of eyes where folks are saying, this isn't how I think about my farmland. And you don't need to, and individuals shouldn't, in fact. But at the margin, this is how the next price for a transaction is likely to be determined. And so, an auction this afternoon that might happen or might not would have some folks in the audience thinking about, I have alternative investments I can make, and what is the expected yield on this asset? And so at the margin, we do see prices largely set by this approach to thinking. Farmland values are plotted here for 3 states, Illinois, Indiana, and Iowa, in 2 different forms, all the way back to the 70s. So we can look at what I think of as the one big farm crisis in the 80s. And it's a very different world. We're down at low interest rates. We don't have nominal mortgage rates of 15 and 16%. And so you look at the top one and it just says, what was the treasury rate and what was the yield you would have gotten by just directly investing passively in farmland and just collecting the rent? And as an operator, rent should, for many people, be thought of as the long-term minimum return, plus all the other benefits from having the ability to be on the farm and the other kind of mixed benefits. And what we see is the crisis of the 80s is when it got really, really out of whack, where farmland did not generate what it cost to own, or didn't generate the returns weren't high enough to service its own carry. And in the 2013 to 19, what we see is farmland was actually above treasuries, but farmland markets in the bottom panel are what I like to look at. They didn't go crazy. They didn't overreact. We didn't say that the low interest rates were totally permanent. We moved toward that cap approach. We moved toward that. but we didn't get all the way up to those dotted lines, which is the blind. You know, I always say, if I give this problem to my physicist friends and they calculate it, they're always surprised why everything isn't exact, because in their world it should be. Well, the physics of farmland include people making rational expectations about their future income prospects, their future cost prospects, their future commodity values. So the low cap rates are very supportive of future values. The low volatility is very supportive of future values. We have ag is increasingly being viewed as an acceptable asset class by investors who aren't only just neighbors. And so this is becoming kind of a pivot point, I think, in the markets as well. And the last thing I'll say on this slide is that the scale in the investable space is still really small. In other words, we're not seeing, you know, the institutional owners still only own percent and a half, 2%. And there is one fairly intriguing new institutional vehicle. Nuveen has launched essentially an evergreen style fund. There are two major other funds and about 3 REITs. Farmland Partners, Gladstone, a couple others have begun to break open the possibility. And then the last one is really interesting. I was glad to hear Kevin talk about blockchain in these terms, but at least 3 companies I know of, Magma, AcreTrader, and Farm Together, have all begun to put together the idea that if you want to sell your farm, we'll tokenize it and you can sell it in individual shares to people walking around in Chicago and buy it on Discover Card during lunchtime. So this idea that you could have people feel more connected to land, I think, is a positive. There are going to be some rocky moments in converting from the markets we have now to a few assets transferring that way, but it'll happen. Moving on, and we're going to accelerate through some of this. Had my phone open here just to check. Markets are, have done a bit of a turnaround, up 373.86 at the moment. On the Dow Jones, down as much as 2,100 yesterday. And I want to bounce through some of this kind of quickly, but tell you how we might see this in history. So the Dow Jones, as of yesterday, when I checked it, was down 27% over a 1-year period. And the peak decline in farmland over the worst 5-year period, including all of those 5 years from 82, 3, 4, 5, and 6, turned out to be about 27% as well. So the one period in history of major volatility equaled a 1-year period, and a 3-month period was even greater in the equity markets. So looking on the right-hand panel really quickly, excuse me, the largest percentage gains, and when did they occur? Well, 1933, 1931, 1929, 32, and October of 2008. When were the largest losses in a percentage case? Well, Black Monday, of course, 87, on a single day. Now, any period of 2 days, the most recent month has dominated, which you'll see in the next chart that I'll put together. But you notice a couple of 2020s are slipping up into the largest percentage losses, despite the fact that we had depressions or housing crisis triggers for the others. This one has been triggered by a health concern. Simple shutdown. If we go to this one, as of yesterday, we would have effectively reset back to about December of 2016. So we just gave up essentially a 4-year period of returns, or 3-year period of returns, to say we're back to zero on this. Where would we have been in farmland? I think those are kinds of questions people are going to remember to ask. So this one is a fun one to look at. On the left-hand panel, we have the 20 largest point gain days, and they're organized so that by the net change in the Dow. And you notice the top 4 are all in the recent month, 5 out of the top 6 in the recent month, and then the rest are reasonably recent, 18, 19, a couple of them in 2008. The middle panel, largest point losses, again, we have the same effect, that this is just unprecedented. There's not much information in what happens. We're happy the markets are up today. There's almost no information in that effect. Or we're sad the markets are down tomorrow. There's just nothing that we can say yet about that. But again, look at the prominence of 2020. And then if we take the top 10 largest gains and the top 10 largest losses and move them over to the right, but order them by date, This is really remarkable to me. And we may have to add another entry after today, who knows? And then the rank in the middle of their gain or loss by whether they're red or green. But we had the largest ever net change recently, and then we have a day after still in the top 10. So the fact that we went 18, 17, 16, 13, 12, 11, 10, 9, 5, 4, 2, 27 a month, all of those are in this year. I think that should give you some pause about thinking about how to compare equity market returns to farm returns and not just pick a once at the end of the year and a comparison to your 401k. So what that means, another graph that I update fairly constantly, and I'll just do one of these given that we're kind of going to be pushed on time. We're going to end in about 15 minutes on this section. Looking at the 20-year return to farmland in Illinois, about a 9% return, about 6% standard deviation. NCREIF, which is a managed investment collection in farmland, has permanent, row crop, and other distinctions, tends to be a little higher than if you measure, according to USDA numbers, the all farm returns to Illinois, because we have a lot of hobby farms. We have stuff in there that's not really commercial farm. But I would take a 9% return over a 20-year period, given what we've just experienced in the equities. Now, remember, this is through 2019, so NASDAQ, S&P, and Dow, which are in the 3 to 6% range roughly, you can take another, because we're down 30% or 20% now over 20 years, subtract another percent off of that, even on a long-term basis. And if one period of time can have a 1% impact on your long-term return, I think that's going to cause investors to think about the role of real assets as opposed to financial assets in their portfolio. Again, we're going to run out of time, I recognize, but the correlation column on the right-hand side, excuse me, farmland has also shown over the long term a positive correlation with inflation, which I think is not to be ignored or forgotten, only because we have just had, 10 years or so or 12 years with no meaningful inflation. Don't remember that effect still exists. Moving on, if we shorten the period to 2010, typo in the very top there, farmland returns should have said 2010 through 2019, but the table is correct, 2010 to 2019. It doesn't change the pattern much at all. It changes the levels a little bit, but what would you like to do when you have that amount of risk? I will not go to the live version here. We're contemplating doing that a little bit, but there's something really critical here just to see. I'll give you a quick orientation and then let you kind of study those pictures if you're at all interested. The top left one is Illinois, and the insert is the rate of return you get, and then the diagonal matrix there, if you will, the stair steps are the 1-year rate of return. If you move in one row, it's the 2-year rate of return. If you move clear to the top right-hand corner, it's if you bought back in 1991 and sold in 2019, what your total return would be. The fact that it's all yellow, it's very stable, and there's not much variability in the bottom, like cable, if you will, and the bottom two charts are just statistical measures of the variability of return by holding period. What you get as an investment kind of implication of that is that it's a very safe investment in the long term. If you'd bought in 1981 and sold in 1986, you would have suffered a really bad decline. But if you had held it for 5 more years, you would have been back above zero. There are periods in the equity markets where that's not true. Each time you see one of those long red stripes, like 2008 in the Dow Jones, or one of those stalactites in the insert 3D graph, it takes 1, 2, 3, 4, 5, 6, maybe 8 years to get back above water. So the timing really matters. And what we do know is if we stop today, we're going to put a great big red dot on the bottom right-hand corner of this for 2020. When 2020 arises, it's going to be difficult to get all the way back. Hopefully I'm wrong. Hopefully we do get the equity markets to get some stability going on. We can do the same thing with total farmland, same story with all REITs. In case you were wondering, all REITs, if you wanted to look at commercial markets as another form of real estate, farmland sometimes suffers from the fact that people say, I really want to invest in real estate, but the only thing I can find is a strip mall in Des Moines. Well, the commercial REITs largely represent that. Farmland is beginning to show a little bit more broad availability to investors, but the same story exists. It's a remarkable asset no matter where you measure its returns. Important to institutional investors, likewise, is the diversification effect. They all wish they had 50% farmland the last 2 months, as do I. Wish I had more farmland the last few months. But the correlation through time over a reasonable holding period, institutional investors focus on 3-year rolling quite often. And over a 3-year rolling period, when ag is up, financials are down, owner financials are down, ag is up, and so on. So, and consumer price index, again, if you go all the way back to the 70s, the CPI, or the protection for the long-term inflationary side of ag, is really quite good for farmland. Just another way of looking at the same information. Illinois looks pretty good compared to the equities, and then the NACREIF returns look especially good. But remember, those are specialty funds. Those are difficult to access, really important for institutionals. It becomes the best index, I guess, for the availability of returns in the agricultural sector, and gives me a lot of hope that in the long run, we're going to do well. All right, now back to a couple of other things that I think are worth remembering as we move forward. And again, we're going to run out of time a little bit here. Not a lot to continue through, but this next one I want to spend a little time talking about because it's such a messy, crazy slide. I think one of the things that we have not paid as much attention to generally in agriculture as it appears now that we should is how things like today's crisis impact what people want to know about their food going forward. You've heard the absolutely absurd questions on the street about, can you get coronavirus from eating Chinese food? Of course not. Can you get it from drinking Corona beer? No, it's a different. So there are these like spillovers to the demand for information that have also happened, that are happening at exactly the same time. We had probably the highest pressure ever, although there's been a bit of a gap in the news coverage on this, about the impact of agriculture on greenhouse gases, and in the GMO debate, and in other places where we're going to have pressure from consumers and folks who don't really understand their food system very well, who want to, force everybody to have a particular kind of produce in their grocery store, and how much methane animals release, and so on. The chart on the kind of left, that's greenhouse gas across the supply chain. Again, the counterfactuals really matter here. So there are ways of producing beef in confined houses with methane digesters that might actually generate positive amounts of carbon capture in the methane, counting all the way back to the cycle of the food that was consumed and the amount of green material captured in plants to feed to the animal. And yet we have to face, as an industry, this kind of chart and explain it. We have large energy companies saying, well, we're planning to be carbon neutral by a certain period of time out in the future, to signal to consumers that they care, or that they understand that the relative cost of extracted oil is going to eventually be higher than the relative cost of something like, say, ethanol. The trillion ton possible to sequester. There's some really interesting efforts by folks like Indigo and others to begin to develop carbon markets, or find ways of measuring the marginal impact from putting another, 4 tons per acre of carbon back into the soil through soil health initiatives. Great if we can capture the benefit not just in soil health, but also by a credit for carbon, or an actual market traded. That would be great. The little one, I become involved with Equilibrium in a very minor way, but I love their mission statement. Equilibrium has gone on record of saying, look, we care as much as everybody, but we recognize the importance of being able to use markets to move the planet to sustainability and prosperity. The BlackRock quote, the Beyond Meat thing, the genetically engineered cow kind of stylized impression there. All of these are coming together, though, and facing agriculture kind of as an army of questions that I don't think we can continue to ignore. And so I think turning the narrative to a positive frame and saying, well, relative to the future, I always ask the question like this: do you think there will be more or less people on the planet? Choose your answer. Do you think they'll eat? Again, choose your answer. What do you think they'll eat? Well, choose your answer, but it's going to depend on the cost of food, and the cost is going to summarize the attributes people are willing to pay. and how much money will people have around the world, which is a long-term growth question that I think we need to settle. The China issue, the India issue, the parts of the world that have a large population that can increase their consumption of food or can increase their expenditure on food dramatically with changes in GDP growth. That's why I always worry first about the growth rate in China rather than the growth rate in the US. We have relatively few people and already have pretty rich diets. But those issues are beginning to really land. I think the attention we pay to COVID for the next few months may put a bit of a gap in that kind of flow of questions, but they're still going to be important questions to begin to manage. And historically, we were, as a sector, not nearly as concerned about communicating directly to consumers. If you think I'm wrong about that, you could ask Monsanto about their experience with Roundup. But figuring out how to manage the messaging in an accurate way and be part of the solution instead of the problem, to me, is a long-term super positive for agriculture, because we do have, I think, very sincere, we represent the only industry that has any meaningful chance to sequester large amounts of carbon. Other sectors can avoid using so much, convert to LED light bulbs or whatever the tactical issue is. But if you want to actually capture carbon, you kind of have to put it back down in the soil, and organic matter in soil is the way to do it. So key issues to monitor in ag going forward. The last couple minutes to get us kind of onto our time channel here. Potential disruptions in food supply chain, and this can happen in any way. It can be the COVID, it could be a trade debate that we lose, or it could be a preference for plant-based meat, or it could be whatever it does. The disruption in the supply system, we don't have really good channels to reroute other things. It's difficult to look at the labor market separately from agriculture right now as well. I think that's really important. But that's a big deal, and it tends to be, the way I think about it is, you can, for certain assets and certain expenditures, you can delay them, but you don't change them. So some things, if you don't go to the grocery store today, you probably buy a little bit more food tomorrow. Or if you buy too much today, you buy a little bit less tomorrow, but it doesn't change too much the long-term demand for that. There are other things that if you skip, you can never have to make up. You can say, I didn't go to the restaurant yesterday. It's not going to be the case that I go to the restaurant twice today. So that one's a big one. Trade and the ability to exercise a comparative advantage long run, really, really critical. This is an important, really important long run issue, is to not disrupt the rate at which we're moving forward in the ability to trade with partners and exercise comparative advantage. Consumer preferences, talked about those a lot, but increasingly we're trying to find ways of going free from something. Free from hormones, free from inputs, free from nitrogen effect, free from water, salmon impact. And the movement toward regenerative and biodynamic will probably happen for reasons that consumers are willing to pay more for that, for those attributes. It's very much, we're used to in the ag market saying things like high lysine corn should be worth more than number 2 or whatever, but this is increasingly important. The next one, my favorite one, genomics replaces genetics. We're eventually going to get to the point where we quit arguing about certain things that are like gene sets or words that seem to scare people. One of the possibilities is that I think this current experience we're in with COVID is helping people get a little more comfortable with the fact that the genetically modified organisms in medical sciences dominate in terms of the number and in some sense the expenditure compared to those in agriculture. So we have historically thought of that as an agricultural issue, and it's increasingly not. It's increasingly a medical issue, increasingly can we quickly get to using things like CRISPR technologies, the matching of genetic response to something like a viral pressure. I think that will be very positive for agriculture as we begin to dilute the debate and dilute the reactions by consumers to certain issues around GMOs and other things like that. Alternative proteins and plant-based meats, I've said this for a while now, small issues shape really large debates. But the question is, if the entire world were going to eat a whole bunch of plant-based meats, where do you get the yellow pea proteins and the other things that you feed to the lab that creates those meats? You still have to grow them at some point, and it's not quite as obvious as people would like to argue whether or not that's good or bad for agriculture. I've quit displaying a chart that I was putting together that said the number of calories in and the number of calories out because it just evoked too much debate. But is a pig's stomach a better laboratory than a laboratory is a pig's stomach? And these are questions that I think will kind of settle out in the next few years, but it's not clear to me if it's positive or negative in agriculture yet. We always said China, China, China were the most important things to worry about the demand side, and then Mexico and Canada. Mexico and Canada, great numbers, but much more stable. So even though they're great big giant trading partners, we didn't historically have as much. Well, now we add China for a different reason. We're adding that one in as another concern. Finally, last 2 points. The ag sector financialization is occurring at the margin, and so we're going to be debating whether or not capital flows are going to come into agriculture until we see if they do or don't. I'm relatively positive that for the investing community that's been, looking at their commercial real estate portfolio and then sees agriculture on the side. The ability to begin to develop different ownership and operation and capital stack ways of controlling the ag assets are beginning to appear as well. So this idea of tokenizing your farm and continuing to own it and farm it, but 15% of it is owned by the people who decided through a blockchain technology to give you $12,000 an acre to have nominal ownership of the production system. And then this is really good time to consider balance sheet management. Loan offerings are still going to have a bit of a rate lag, but most lenders would rather have you negotiate a rate down now than for you to walk away from them for another first-time loan with somebody else. So I think it's actually a good time, good for the lenders as well, because they may not give you 100% of their savings on funding for rational reasons, but it's a good time to do it. And in the end, what asset would you rather own? It's a really good portfolio asset. Farmland turns out to be a really good portfolio asset for the operators, for the owners, for the institutional investors. To me, it remains that, and in the long game, still looks like a winner. I think this will, the results we've had of the incredible effort that the members of the society perform every year. They squeeze in this survey into a busy time of the year. They've put together phenomenal narratives around it. We organize and have stored now the data for roughly 20 some years and can look at an absolutely exceptionally accurate value of the farmland markets in Illinois. And that's what we're going to turn to next with Dave and Gary. I think we're going to take a really short transitional turnover break, and then we'll be back on with materials that relate to the book that you should have gotten by email as well.
Yep. So
Sounds good. Thanks, Dr. Sherrick. I learned something new every time you speak, and today's no different.